Welcome back. Spar's year-end results have revealed a remarkable turnaround. The retail group reported notable gains in turnover, operating profit, and a reduction in debt. CEO Angelo Swartz joins us now to dive into the details of this performance and Spar's plans to further optimize its operations. Thank you so much for your time, Angelo. Of course, we have seen this uptick in the financial metrics of your continuing operations. Is this a result of very difficult decisions bearing fruit?
I'd like to take complete credit for that, and I guess it is. But it really is testament to our teams and supporting the vision that we have. As you will see from our continuing operations, we've been really strong on cost control, and our teams in the various divisions have really focused on that. We've managed to keep cost growth at 3.5% across the business, and that includes our European subsidiaries, and under 3%, somewhere around 2.3% in SA, which is phenomenal given the overall inflation environment over the year. I think that our team have done a phenomenal job.
All right. Angelo, I do note also that you did mention a slower growth in turnover in the second half of the year. I do get the currency translation impact that is out of your control, but do you think that there are headwinds that could outlive better economic sentiment, or do you think that you may have reached the bottom of the challenges in this reporting period?
I'm always wary to say that you've reached the bottom of the challenges. I don't want to tempt fate. I think there are certainly headwinds that are going to prevail. I think the economic environment in the West, and particularly in the Eurozone, isn't nearly as solid and as positive as we're seeing in SA, which isn't something we always say, so we should be really grateful for that. So I think in mainland Europe, our Swiss operation, I think there's going to be continuing pressure there. And the pressure on the consumer, aside from the macroeconomic factors, the pressure on the consumer in the West is something that you've seen played out in the political cycle, and it's playing out in how people live their lives. And what they're calling the cost of living crisis, although I guess in SA we might feel that's a bit of an exaggeration, but certainly in the European context, that's what the level of inflation that those economies have gone through in the last year has impacted consumers quite heavily. I think what we're seeing, we've got an election coming up in Ireland, and that's quite important. Once we're through that election cycle, hopefully we expect there to be stability in Ireland and some certainty, and I think that'll certainly be good for the consumer. And then the UK has been a really tough economy to us, very tough economy for everyone really. But we've felt it particularly keen.
I do get that obviously the macroeconomic headwinds in the UK, but I guess really the big concerns in your business have been in two markets, really, Poland and Switzerland. Of course, we know that now Poland is a discontinued operation, but there are still continuing headwinds there in Switzerland. Are there any conversations that are being had in terms of handling that market?
Yeah, there are many, and they happen quite frequently, almost on a daily basis. The Swiss business is one, and the performance is one that we're worried about. I think, as I mentioned, there are macro impacts there, and then there's some impacts in terms of how we run the business day to day that we think we can change and be a bit more aggressively priced. We've focused in Switzerland very much in the convenience segment and much smaller stores than you'd be used to seeing in the SA market. And the convenience sector doesn't have the best price perception in general, and consumers in tough economic times obviously choosing to shop at bigger supermarkets has impacted our business, certainly. And then also consumers choosing to shop across the border. Switzerland has easy access into the rest of Europe, and food prices significantly lower in the rest of Europe than they are in Switzerland. That's also impacted the performance. But I think there's some choices we can make around how we position in terms of price, the value we passed on to consumers, our aggressiveness in terms of promotions and advertising that can impact, that can make some short-term gains in Switzerland, and we are considering how we manage that. And then in terms of the future positioning of Switzerland within the broader Spar Group Limited, is something that is coming under question. As a business, we are very focused on how we allocate our capital.
Yeah.
And where our capital is allocated poorly, or we aren't getting a return to our satisfaction, I think we want to be quite clear about that and make decisions as decisively as we can.
Okay. In terms of Poland, are there any outstanding obligations that you have for that business?
No. So where we are with Poland, depends on how you define obligations. But we are in the final throes of going through the due diligence. Yes. So we've now received official Competitions Commission approval. The buyer, a local Swiss wholesaler, is running through a confirmatory due diligence process. Unfortunately, because of the nature of the Competitions Act in Poland, they weren't allowed access into some competitively sensitive data before that approval happened. They've got 30 business days to do that. They are quite bullish about the purchase and quite excited about acquiring the Spar license in Poland. So I expect that process to run. It will run until the 7th of January. And then hopefully closing will happen, in terms of the SPA at least, closing is defined to happen on the first business day of the next month. So around the 1st of Feb. In terms of financial obligations, we've kept in place a working capital facility in Poland, although we've now settled all the debt.
Okay.
So all the medium-term debt has been settled. The only obligations we have as we speak is a working capital facility, an overdraft. Really.
All right. Let's bring it back to South Africa, because of course one of the biggest headaches was the SAP implementation. Are you still experiencing adverse effects from that?
No. So the period definitely saw adverse effects from that. The second 6 months.
Yeah.
It hasn't impacted our sales for some time, and we've been able to, for the greater part of the last year, we've been servicing our retailers really well in terms of getting them the products they want on time. But we have had issues with our gross margin and our pricing. There was a system enhancement that was delivered at the end of September, and that has now been installed. Our teams have found it very, very useful, and we've seen an uptick in our margins since then.
Okay.
But it certainly did impact the second 6 months performance. The good news is the month of October, we've seen a real bounce back in KZN, and the business really operating at a good level of profitability, not quite where it was before we went live, but close enough that we are satisfied.
Okay.
Yeah.
Well, thank you very much for your time, Angelo. We do have to wrap up the conversation there. Thank you so much for giving us insights into the numbers that we saw coming out of Spar. That was Spar CEO Angelo Swartz.